Okay. Hello, everybody. Hello, 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 hello. Okay. This one is, listen, I'm just going to lay this one out there because I get this so often. Um, and you know, it's just people get wigged out. Oh, the capital stack. Oh my gosh, what's a capital stack? Folks, it's whatever it takes to get you to 100% of the purchase price to close the deal. When you're buying a house, you always ask, how much down? Do we have to put 20% down? Well, that 20% is part of your capital stack. The other 80 is from the bank. Boom, there's your capital stack. In multifamily, we might put the stack together differently, all depending upon the type of deal. So let's take a look at some of the options first off. Okay. And I'm going to talk about different things. I'm going to actually write some of these down so I don't forget. But the first thing is the base. There are two questions you always have to ask yourself when you're looking at any multifamily deal. Two questions. First is, what's my exit strategy? How am I going to get out of this deal? Because remember, as investors, we make our profit when we buy the property. We realize our profit when we sell it. So what we always do is try to figure out, well, at some point, I'm going to need to realize my profit. How am I going to be able to exit this deal and get my profit off the table? And that's always one of the questions. The first question you have to ask. The second question you have to ask is, how am I going to get this deal financed? And that is the basic question for understanding how you're going to build your capital stack. So basically, the first building block of any capital stack is the debt. So that we're going to go to a bank. Always ask yourself, how am I going to get this deal financed? And you look at it like, well, is a bank going to finance this deal? No, it's not non-performing, too risky, bad area. Banks won't want to touch this. Okay, where else am I going to turn to build my debt part of the capital stack? That's how you figure out where you're going to be headed in this particular deal. Let's say it's a beautiful property, looks great. Okay, well, if that's the case, then we're going to go to a Fannie or a Freddie, a government-sponsored entity. We're going to get the cheapest, less risky deal from the banks that we can. And those tend to be government-sponsored entities, GSEs, Fannie and Freddie. So if we're looking at starting there, the terms that you can expect with a GSE are lower interest rates, okay, very competitive interest rates, higher loan to values, which means you don't have to build as much to your capital stack, as opposed if I go to a local lender, the guy might give me 70% loan to value, sometimes it's 65%. But if I go to a GSE, I could get 80% loan to value. Well, if I go to a 80% LTV, then I don't have to raise as much money as I did when I first looked at this particular deal. So that's why when you look at a good property, one that's very nicely performing and it is a good quality asset, you might not have to build as much of the capital stack. It'll all be there for you from Fannie Mae. So they'll also give you non-recourse loans. That means, but for the bad boy provisions, you are going to be able to fail and drop the keys on the bank's desk and walk away. If you're dealing with a local lender, you're not going to get that type of coverage. You might get partial non-recourse, but with a Fannie Mae or Freddie Mac, that's where you get the true non-recourse. All right. So that's the debt on a good-looking property. Now, what happens if you're not buying such a good-looking property? Well, the opposite end of the spectrum, and I'll be honest with you here, the opposite end of the spectrum is seller financing. If I hear that the seller is willing to offer financing on this particular deal, red flag. Why? Why can't I go to a bank? No bank's gonna loan to you on this particular deal. For me, that's a deal killer. I don't want the guy to be the bank. So that is a red flag. I'll walk away from that deal. The other thing that you have to understand with any type of seller financing goes back to this conversation about the capital stack. I'm going to offer you seller financing. All right, well, if you're going to offer me seller financing, that means that the let me see. That means that the if the seller currently has a mortgage, he's not going to pay off that mortgage and then turn around and give me a mortgage. He's going to continue to pay on that mortgage and then just add your debt to the top of it. And what that means is that you're not in the first position. He is taking one bank to build the base of the capital stack, taking his bank to build the base of the next part of the capital stack, then your down payment, and that's how he's making up the full capital stack. So those are the two extremes of the capital stacks. Now, what you have in between, yeah, I mean, you can have local lenders that don't give you the same type of terms as a Fannie Mae or a Freddie Mac, but if you have a problem and you're having little business problems, I'll tell you right now, those are the best guys to work with. They will go in there and help you rewrite the note and get you through troubled times. The GSEs, not a chance. Not a chance. Now, the next part, and I'm going to share with you a slide here. For those of you that have seen my presentation about the deal that we're doing right now in Louisville. So if anybody wants to find out more about these deals that we're looking to do, Molly, why don't you go ahead and just put the link in the chat box. But take a look at how we're doing this. This is our capital stack right here. This is how we go from 0 to 100%. Now, the first thing is going to be the base loan, a bridge loan of 65% loan to cost. Now, folks, this 65% is actually a bridge debt. It's not a bank. It's a bridge, a debt fund. I'm sorry, I misspoke. It's a debt fund. And what that means is that we're not dealing with a bank, but we're borrowing money from a investment fund. And they're going to look, act, and feel like a bank, but they're going to be operating as an investment fund. So it's a debt fund that we're getting that money from. Now, the thing about that, and what you will see, I'll go back here, is now what we have to do is we have to figure out the remaining 35% of the debt of the capital stack. So remaining of that 100%, we have to find other sources. We've got a preferred equity fund right here that actually we put these guys above here. This is where you get, now you're up to 65 plus 15. Now you're at 80% loan to cost. So what we've done in that particular case, so that everybody can understand what we're talking about here, is we've got that debt fund on the bottom. Then we've got a layer, a 15% layer of what we're calling preferred equity. And it's the way it works is it's actually like another fund on top of the debt fund. And that both of those funds look, act, and feel like a mortgage, a bank, coming from a bank. So we've got, if we don't pay it back, they can take the ownership of the property, just like a mortgage. So that's how we get ourselves up to 80%. Now let me share with you the remaining one right here. Boom, share. Now we get the common equity. Now that common equity is what we're developing right now. That's actually, it's a little bit less. It's more like 1.3 here because our bridge loan is actually 7. So we're looking more at like 1.3 here. So we've already, all the investors in the deal have already put in their equity component. We brought it up to 300. So now we're coming up with $1 million. We have a couple of weeks to raise the $1 million, and that completes our capital stack. Now we can go out and buy the property. That is how what the capital stack is. It's just a fancy term for where's all your money coming from. So if anyone is intimidated by that, don't be. It's just the smarty pants on Wall Street trying to make you feel like you don't know what you're talking about. That's all it is. So that is what we are doing with our capital stack for our debt fund. Anybody have any questions on this? Do you have to raise all of the money before you close? No, not necessarily. You can, but the bank is going to want to know that you're at a certain level. You've got a certain amount of money set aside. So that's part of why we're doing what we're doing. We want to get all the money up front. The bank will wait, as we continue to raise after closing if we need to. That's always something that's out there as well. But that's pretty much how we're doing this. Is we're putting together 3 levels, 3 layers to put together the capital stack. These people can walk in and write a check. That's their capital stack. Those people have to go to the seller for seller financing. That's their capital stack. So just understand that is all it takes to raise a fund and to put the funds together to close the deal. Let me tell you, I got some interesting conversations that I put out on TikTok from students of mine. My students have asked me a couple of good questions. Let me tell you what we've got. One of the questions had to do with, do I sign a broker exclusivity agreement? And I said, H to the no. Heck no, you're not going to do that. You never should. These brokers work very hard to get their listing. And the last thing they want to do is have to split that commission with somebody else. And so if you show up on their doorstep looking at their deal and you've got some broker in tow who wants half, you're not going to, your offer is going to go to the bottom of the pile. Don't do that. And the other reason is because when somebody shows up to split a commission on a commercial deal, that just screams rookie. That just screams like, hey, this isn't my property, but I want half of your commissions, like a residential deal. And you just don't do it. So never obligate yourself, never tie some company down. And I'll tell you something else. Let me just give you a little bit of legal advice here. Whenever you sign any type of contract, you are obligating your business, your company, in a particular way for a particular future amount of time. And what I mean by that is I get people that send me over confidentiality agreements. My clients know they're not allowed to sign any confidentiality agreement unless I've had a chance to take a look at it. And basically the 2 things that I look for to make sure that it's set are, number one, that it's the CA, as we call it, is limited in scope to the actual property that's under question. All right. So what I mean by that is, that if the broker sends over a blank form for the confidentiality agreement, don't sign it. Don't ever sign any blank form. But what happens is if you open it up, they're going to use that confidentiality agreement on every deal that they send you, or every deal that they have. Say, hey, you can't use that. You can't look at that property, or that's exclusive to me because you signed this blank form. Don't ever do that. The other thing that you always want to make sure with a confidentiality agreement is the term. Don't go beyond a year. And, or it should be only as long as the property is under contract or being represented by the broker. But 12 months you can get by with. If it's anything more than that, don't sign it. Why would you? What you're doing when you sign any type of contract is you are obligating your company to be put under some burden or some restriction for something in the future. Well, I forgot I signed that. Now I'm in breach of a contract I just signed my name to 2 years ago. Yep, well, you're in trouble. So don't obligate your company to things that you just don't want to even have to deal with after a certain amount of time. Keep the time limit short and make the scope very, very narrow. So those are the two things I wanted to make sure that you understood about those things. And that's what one of my students had sent to me. But that's it. That's all I wanted to share with you. I wanted to give you a quick little lesson on the capital stack so you can understand exactly how it works, that it's nothing to be afraid of. It's actually putting the finishing touches on that first question you must ask yourself. How am I going to get this deal financed? So keep that in mind and go for it. Let's do this. I'm going to a concert tonight. Just thought I'd share that with all of you. Going to a concert. One of my favorite performers, whenever he's in town, I like the piano, and it's Jim Brickman. Wrote a lot of Disney songs, got some famous stuff, but I like his little concerts that he gives. He gives a lot of them up here in Manchester. This one's down in Boston. So I'm going to be heading down there to check out Jim Brickman tonight. Look him up. Look him up. You'll enjoy him. All right, everybody. Great to see you all. Thanks for coming. And remember, this is the link if you want to find out more about the Louisville deal. As I mentioned before, we have a very short raise for that one. But if you're interested, please sign on up and we'll get you the information. I'll have my investor relations people contact you. Thanks, everybody. Good to see you, and we'll talk later.